we're going to look at a... Okay guys, as a basic introduction, you need to always be vigilant and don't overcomplicate money cash flow and your calculations. It's very simple. It's your cost minus your income minus your costs, is your money in or money out. So it's a very simple analogy that you should always bear in mind. Don't overcompensate or complicate this calculation. It's all about cost. So firstly we look at cost, and cost is basically your money out. So it's salaries, wages, general costs, merchants, supplies, etc. And control must be exercised over your creditors to whom money is owed by checking invoices carefully, making sure that the goods or services have been supplied, and not paying the account too early. Secondly, we look at value. Value is the amount of work that you've done or that you can invoice for. So value is money in, the value of work carried out as certified, usually based on the quantity surveyor's interim valuation. Okay, then cost control must be exercised over your debtors from whom money is owing the maximum cash flow. To get that, your value excludes the value of work in progress, work carried out which has not been invoiced yet. Okay, so please bear that in mind. We're going to look at for instance your retention and those items as well. Then we get into cash flow. Cash flow is very simply the difference between the money in and the money out. Sufficient working capital must be available to avoid overtrading. Taking on too much work with insufficient liquid funds and liquidity will lead to liquidity problems. Okay, so firstly, reporting your procedures. A realistic budget is needed. That's always the challenge. Then monitoring is an essential part of the process. As the organization grows, so does the importance of the financial reports. Financial control systems. The Pareto principle applies here, where usually 80% of your cost lies within 20% of your items. So if you manage 20% of your items very well, you can manage 80% of your cost very well. Thus, these items have to be managed well. Okay, monthly cash flow reporting. So this is what we're going to look at. We're going to look at your monthly cash flow report. Is basically you've got your inputs, you've prepared your budget, you've got your value, and you've got your cost. Reconciled value at the reconciliation date, reconciled cost at the reconciliation date. So you analyze it, your cumulative and monthly position. You either have a profit or loss. Your cost report, tubular graphical formats report to your management. So it's basically in and out report. Okay, so we're not going to look at that in too much depth, because that is done in CFNR extensively. But we're just going to look at an example. Your monthly cash flow report may look something like this. So for month 1, you have your certified value, that's the amount of work certified, your reconciliation value, your cumulative costs, and then your cumulative profit is actually your 29,000 minus your cumulative cost is 4,000, and then your percentage that you're actually in is 16%. So it's 29 minus your value of work that you've done, and then your profit. Just note that there's a bit of a subtraction here for your certified value. It's just a retention that they've got here. Okay, so please just note that. So very simply, you just do your math and you calculate each month what your profit and your inflow and outflow is. Okay, and then from there you can just extrapolate that to get a forecasted value as well. So you can compare your forecast against your actual. Okay, so this is just a bit of an introduction. Don't worry too much about this. We're going to focus on an example just now. So these graphs you guys should know by now. It's very straightforward. You've been shown this extensively, but basically you've got your value of work. So you've got your cumulative value forecast. So this is what you think your cash flow or your value of work will be, and then you've got your actual reconciled cost, which is now the green line, and then you've got your actual reconciled cost. So your cost is just that one there. So this is your actual profit release that you've got. Okay, and then you've got your actual value. So this is your value variance. The client is very interested in that. And then your time variance, the client is also very interested in that. The client is not interested in this, your actual profit release, because that is for you as the contractor. The contractor or the client is interested in that up to the point of whether you can continue with the work or not. Okay, so obviously you have a shortfall of budget forecast with actual value. Okay, then the next graph just shows value time forecast, time relationship. So it just gives you the actual, you can do the same cumulative value for time. This is not that important, it's just basically a duplication of what was done in this one. Okay, so take only note, then there's these examples here. Just take note of your profit release graphs, and then you have your monthly release here. So all it basically says is it shows you profit, cumulative profit, your percentage on that. So it basically just shows you that you had a good profit margin, and then it just slowly tapers down from the cumulative profits, and then you a percentage now on what you actually wanted to have. So it just shows you that you can just calculate that your profits were well or good in the beginning, and then it just tapered down, but obviously you probably had more costs and that type of thing. These graphs is very helpful when you're planning for new projects, when you want to evaluate your completed projects and look forward. So, but please, this is not that important. Just take note, this is quite handy when you guys get into a firm and you have multiple portfolios and you want to have a look at your percentage profit release. Okay, so getting into our actual example, so this is the one that we did in the workshop and the other day. So it's a very simple example, but I want you guys to be able to do this. I'm just going to page to that example. So it gives you a scenario of a contract value of position. So you have your cumulative value forecast, and then you've got your cumulative value that you forecast for the project, and then you have your actual value. Just note this is value. Sorry guys, this is value. Pardon my writing, but this thing doesn't really allow for writing, but this is not set, so it just helps with that. So this is actual just value, and then they have the cumulative costs. So I'll typically give you a scenario like this, and then you must be able to calculate the value variance and the profit variance. And the value variance is very simple. You've got your cumulative value minus your cumulative, or your actual cumulative. So you've got your forecast minus your actual, and it gives you a difference of 8,000 Rand, and or pounds in this case, and then your profit variance is very simply your actual income or cumulative value minus your actual cost, which is 2,000. Okay, so you do that's for month 1. You do the same for month 2, for month 3, and very simply you go onto your little grid line that I'll usually supply, or you can draw your own, and then you just plot your cumulative value on here. Okay, so your forecast value, so this is the first graph that you put on. Okay, so it's your 30, your 90, your 140, and your 180 according to the duration here at the bottom. Okay, and then you put your actual value in this dotted line here. Okay, also according to month 1 you had an expenditure of 22,000, and then you've got your month 2 you had a value of 65,000, your actual value, and month 3 you had an actual value of 100,000. Okay, so from this graph you can actually calculate your value variance, which was 40,000 at month 3, and your time variance was approximately 3 weeks, very simply calculated by drawing in the grid lines from your actual value to your planned value, and taking it down to your where it cuts your graph, and you can see that's approximately 1 week with 3 weeks on this side, so it's approximately 3 weeks behind. Okay, and I'll give you guys that scenario again, that one that you guys did in class for me, and then I would expect you guys to be able to do this and calculate those items. Okay guys, thanks. I think that's more or less for this chapter what I wanted to discuss. Like I said, like always, mail me if you have any questions, or do not hesitate to contact me in the morning hours. Thank you. Bye.